Let's take a look at the iShares Global Minimum Volatility Factor ETF, ticker symbol ACWV. It was launched just a little over 14 years ago, and since inception, it has had a total return of 219.4%. On an annual basis, that is a compound annual growth rate of about 8.54%. Now, as the name implies here, global minimum volatility, this ETF invests in low volatility stocks. And the thesis behind that, besides the low volatility point, is that over a long period of time, it would have a risk-adjusted return that is better than market beta, or the broad market. Okay, so you're going to get better returns on a risk-adjusted basis. In other words, more returns for lower risk. We'll take a look at the actual performance here in a second, but a few things I want to point out about this. Particularly, it has an expense ratio of 0.20%, so it's relatively low fee as an ETF, but the holdings. Now, the name tells us it's global, right? So you're getting global diversification here. But as a low volatility ETF, I would typically expect the holdings to be largely weighted in utilities, healthcare, and consumer staples, typically the defensive sectors. But as we can see in the exposure breakdowns of sectors, this fund is holding 21.19% of its market value in the IT sector, tech sector, and 15.39% in financials. So what is that? Close to 37% in IT and financials. And then finally, or not finally, but the third sector, we see healthcare, one of the more traditional low volatility sectors, and then further down consumer staples and utilities. So this really stands out as interesting to me that it's holding so much in tech and financials. Nothing wrong with that. That's just an interesting point, because when I'm thinking about low volatility and defensive portfolios, I'm typically looking at consumer staples, utilities, and healthcare. But this fund here is, tilting away from that by nature, and maybe not by nature, but in practice through its methodology of selecting low volatility stocks. Just an interesting key point here. Now, one other thing before we get to one other thing to point out before we go to the performance is who this fund really appeals to, and that is investors that want to sleep better at night, knowing that they don't have such high downside risk. All right, and this might be the crowd of investors out there that can't stomach drawdowns, or maybe investors that want to get more exposure to equity, but they really have a hard time taking that step in. I know it is very hard as an investor to put your money in the S&P 500 when you know that there's a chance of 25, 30% drawdowns happening fairly regularly in the market or every few years, and bigger picture, much larger drawdowns like we had in 08 or 09. A lot of investors don't want to risk that, and a lot of investors simply don't want to see their capital decline substantially. I hear from a lot of people out there that are financial advisors. Investors can typically stomach a 10% drawdown, but when things get close to a 20% drawdown, people start feeling really uneasy. And this fund, or this ETF, is really intended to invest in those lower volatility stocks that are not likely to have such a high drawdown. So on that note, let's see how it has performed relative to the broad market here. So we have ACWV, the ETF on the chart here. Let's add Vanguard's total global market ETF to it. Here we go. We've got Vanguard's global equity ETF on the chart as well, going back to the inception point of ACWV. And we can see that over this time period, the total equity portfolio has outperformed the global minimum volatility ETF. And for the first several years, they were kind of neck and neck. And then after COVID, things got a little bit crazy here, and the global equity ETF got a little bubbly, right? It spiked up there in the COVID bump, then it came crashing down as the Fed was raising interest rates. And well, since then, it is taken back off. But at a period there in late 2022, they were basically at the same total return over this period of time. Ultimately, though, by looking at the chart, we can see that the low volatility ETF has indeed had much lower volatility, but that comes at the expense of total return. Let's kind of narrow this chart down here and look at it through some specific periods. We'll go to COVID. I'm just going to pick a random date here before COVID. And we can see the peak to trough drawdown was a little less for lower volatility than the total global stock portfolio. Let's go a little bit further in time to, say, the end of 2022 or the end of 2021. And again, here we can see that through this time period, the lower volatility ETF had, well, less downside than the global equity ETF here, right? So peak to trough drawdown, and this isn't really exactly accurate, but roughly maybe, 12% versus 22% for the global equity portfolio. Less drawdown, it's holding its weight, it's doing what we would expect. But let me give you the flip side of the coin here. If we fast forward a couple months or about a year, when things start taking back off, we can see the global equity portfolio just absolutely, or the global equity market portfolio, I should say, absolutely rip-roaring ahead and taking off. So you have that trade-off, right? With the low volatility, you do get a little bit of downside protection, or less downside, I should say. This isn't really a downside protection ETF, like something that would be trend following. But you get less volatility, less downside, but you don't capture that upside. Now, let's take a look at the actual risk-adjusted returns here using Portfolio Visualizer is able to go back 10 years, so not the full 14 years. And let's look at a chart here. Over the last 10 years, we can see the total stock portfolio ETF on a market cap basis, because that's what that ETF is, versus our low volatility ETF. And where are we going here? I'm looking for the Sharpe ratio, or maybe standard deviation. We'll start with standard deviation, right? For low volatility, the low volatility ETF, that was 10.58% versus the total world stock ETF at 14.8%. So it has indeed had much lower, roughly a third lower standard deviation. And then Sharpe ratio. Now, interestingly here, Sharpe ratio being a measure of risk-adjusted return, the total world stock ETF has a higher Sharpe ratio at 0.69 compared to the global minimum volatility at 0.57. So over this period of time, the risk-adjusted return was higher for the total world stock ETF. Now, if we were to use a different time period, like right here at the end of 2022, I have no doubt that it would be higher for the minimum volatility ETF. But considering since then we've had a rip-roaring bull market, we see a higher Sharpe ratio for that total world stock. So the point is that it can vary, from time period to time period in what we have selected. The standard deviation, right, and really volatility is indeed lower with the minimum volatility ETF. But the ultimate risk-adjusted return here is really going to be a factor of the time period that we're looking at. I'll touch a little bit more on that when I share my final thoughts and winding it down. But let's jump into an alternate, holding to ACWV, and that would be Vanguard's VMVFX, Vanguard's Global Minimum Volatility. And I believe this is a mutual fund. Just go back 5 years, and I think we'll see it's performed about the same as ACWV. You could get this through Vanguard, though, absolutely with no fees. Is it a mutual fund or ETF? I should have looked that up before recording here. I think it's a mutual fund based on the 5 characters in its ticker symbol. And yes, I can confirm VMVFX is indeed a mutual fund with an expense ratio of 0.21%. So about the same expense ratio, actually a little bit more, 0.1%, 1 bip, higher than the iShares ETF. But ultimately, it is going to do about the same thing and behave very similarly to ACWV. All right. On that note, what do I like about this ACWV ETF? And I'll just say that, the principles or things that I point out here about what I like could really also be applied to this Vanguard mutual fund here, just to keep it kind of fair and not too promo-y of ACWV. But I like that it is globally diverse. So rather than trying to construct a portfolio of, S&P 500 low volatility and international developed low volatility and emerging markets low volatility, you get it all in one fund. You get that global diversification all together in one fund without having to bring in a bunch of different funds. Now, I also like that it is low expense, 0.20%. And 0.21% for the Vanguard Mutual Fund here. And I like that it is sector agnostic here. So it can go where the low volatility stocks are currently at without regard to the actual sectors and having to keep a certain amount committed to each sector or something like that. Now, one thing that I really like about this ETF over the Vanguard Mutual Fund is that as an ETF, it can minimize and nearly reduce or eliminate the capital gains that it distributes. ETFs, through a mechanism or through the exchange process, can largely avoid capital gains distributions when they're changing holdings. That is one advantage that the ETF has. So if you were looking into investing in a taxable account, ACWV does have a clear advantage here over the Vanguard ETF. On that note, what is my final thought here on ACWV? Well, I would say that if your goal is to stay invested through any market environment, and you're really not one that wants to stomach the downside of holding equities, and you'd like to, you'd feel better about being down less than the broad market than you would outperforming the broad market, ACWV is probably an ETF that you should consider holding. What's your take? Is there anything you feel like I missed out on? Let me know in the comments below. And if you found this video helpful and insightful, you know the drill. Smash that like button to help me out in the YouTube algorithm. I'm calling it a wrap and signing off on that note.